Hey, good morning. Nick Fenton here. Today is Monday, November 7th, and it is 10:45 a.m. Eastern Standard Time. Right here, we're looking at a one-year daily bars chart of the S&P 500 E-mini futures. And what you can see here is that we have been trading within a range previously between around 1100 and 1200. So 1100 support, 1200 resistance. That's a 100-point height on this consolidation pattern. We recently broke above that 1200 level, and in this case you look at this consolidation resistance breakout as a bullish consolidation breakout. You measure that upside potential move by adding the height of this consolidation pattern, which in this case is 100 points is the height, you add that to the 1200 resistance break, and your expected move is 1300. Now we pretty much already hit that 1300 point move, and it's pulled back off of this 200-day simple moving average, which is this turquoise blue line, and now we're just kind of seeing a little bit of range bound action. So what we're expecting here in the next week or two is just a little bit of a breather here in the marketplace, and we're expecting it to stay within this 1200 1300 range. So we moved out of this 1100 1200 range, and we're expecting it to move into this new 1200 to 1300 range. So we asked ourselves, how can we take advantage of that? And we think we can do so with a SPY Iron Condor. So here in SPY, we're looking at the same chart, a one-year daily bars chart. So basically we're doing this analysis based on the action in the S&P futures. You can see here the previous range was right around 110 to 120 level, and we recently broke up above this 120 price point, and we hit this measured move here right around 130. We pulled back, so we're expecting it to stay within a range between 120 and 130. So our play of choice here is we want to have break-evens maybe just a little bit above this 130 price point and a little bit below this 120 price point. In order to achieve that, we've looked at this an Iron Condor in SPY, and here is the Iron Condor. We're looking at the December 2011 as the legs, selling the 130 calls, buying the 132 calls. So that's our bear call spread right there. It's 2 points wide. And then our bull put spread is the 120 puts, selling the 120 puts, buying the 118 puts. And what that accomplishes is what you see here above. So here's the Iron Condor, and you can see on the bottom we've got our price points in SPY, and then on our y-axis here we've got the profit loss, and anything above this zero line, which is this horizontal dotted line here, anything above that is profit, anything below that is a loss. And we've got the probability date over here set to December 17th, and we've set our slices here to the December 17th date. We're looking at this, we'll look at this from a price point of 110, because that's probably what we'll set it at to ensure that everybody gets an opportunity to get filled. So looking at that from a 110 price point fill perspective, what you can see here is we are trading right in the middle of this range, but it gives us an opportunity to have a huge range with a lower break-even at approximately 118.90 and an upper break-even 131.10. So let's look at those break-evens here on this chart. 131.10. I'm going to redraw this here, so we want it to be right around there, and our actual break-even is going to be right about here. That's certainly doable. And then 118.90 was what we wanted on the lower end, and 118.90 is right about here. So you can see it puts us in a really nice position where our break-evens are well outside of this range. And granted, we do want it to stay in a range, but at the same time, there's been so much volatility in the marketplace, it's not a bad idea to have your break-evens a little bit outside of that expected range just to be safe. So over here, the downside to this trade is that the probability of success is only about 35%. Downside that's going to stay between the break-evens, and or probability rather, that's going to stay between the break-evens. Probability of below break-even is about 33%. Probability of above break-even is about 30%. But the upside is that we get this very wide range, and we get a nice fill. And our credit here is 110. The objective is to stay at 1/3 the width of the spread. In this case, we are above, well above 1/3, which the spread is 2 points wide on each of the legs. So this 130, 132 call spread is 2 points wide. The 118, 120 put spread is 2 points wide. So technically, we'd be looking to stay at 66 cents credit or better. In this case, we got a 110 credit with an extremely wide range. We could widen this out a little bit further to make it a little bit higher probability of success, but we do like this range, and we think we're already giving ourselves a nice bit of cushion. So we're going to try and take advantage of this higher credit. And we don't intend to hold this to expiration. We'll intend to hold this week and a half, 2 weeks, and take advantage of some potential decay, assuming that this trade works for us. So if you have any questions about this Iron Condor, please feel free to email Nick at TickerTank.com. Lastly, max gain on this trade is 110 in between the 120 and 130 price points. You can see here on the upside, as you go above 130, you start to see diminished profits until you hit that 130, 110 break even. Then anything below that, you start to see some losses until you cap out at your defined risk point of 90 bucks. So basically, you're risking 90 to make 110 in this huge range. And then over here on the flip side, we've got a 110 max gain until we hit that 120 price point. As you move below 120, you start to see losses until you hit that 118.90 break even point. Then below 118.90, you start to see losses until at or below 118, where your losses are capped at 90 bucks. So max potential loss 90 bucks, max potential gain 110. Again, we aren't going to be holding to expiration, so this is based on expiration pricing. But we're looking for 50 cents or so in decay on this spread in the next 2.5 weeks.